Good morning, everybody. It's Tuesday, June 3rd, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you get any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here, July corn up 3 3/4 at 442. July soybeans are up 6 1/4 at 1039 3/4. And July Chicago wheat was up 4 3/4 at 543 3/4. Yesterday, we had a number of different reports out. First, USDA soybean crush came back 202.4 million bushels. That was better than estimated. They were looking for a number closer to 201.8. So solid data there on the crush side. We also got weekly crop progress and conditions. We'll run through that here real quick for you. Corn, 69% in the good to excellent category. That's up 1 point from last week and just a little bit below the 5-year average of 73%. 93% planted on corn, up from 87% from the previous week. So we're getting the crop in there. Soybeans, 67% good to excellent. That was the first rating we got this year. That's slightly below the 5-year average of 69%. 84% planted on the bean side, up from 76% a week ago. Winter wheat saw a jump in the good to excellent category up to 52%. That was versus 50% last week and well above the average of 43%. Spring wheat, 95% planted versus 87% a week ago. And saw a significant improvement based on last week's rains. 50% in the good to excellent category for spring wheat. That's up from 45% last week, but still lagging pretty good from the 5-year average of 68%. Good morning, guys. I guess what we know this morning, we got some rains on the radar out west, kind of moving through the belt here. You saw a little bit of a bump in crop conditions last night. We were talking yesterday about Russia and Ukraine visiting. It was a 1-hour meeting, and they decided to swap bodies. So not a whole lot of progress on that front, it appears. But outside of that, kind of a broken record. Not much fresh here in our markets. Kind of boring, and we just need something to shake out. So, Ben, maybe give us a few thoughts, and we'll throw it around the room.
Yes. Managed money piling into corn shorts over the last call it 2 weeks, 3 weeks, and probably short 150,000 contracts by now. The overnight weather runs took a little bit of rain out of the forecast, got a little bit drier in the extended forecasts. We did make a new low by a new recent low overnight by 1/4% in the December, and made a new low for the move as well, recent low in July. And we're trading higher this morning. And I think we're in that period where all eyes are going to be on weather for the next 5 weeks. And the thing that sticks out to me is if we do run into, maybe a little more negative weather than we thought, is how difficult it could be to exit this position. When you look at a lot of different profitability matrices as we do, there's not a lot of appeal in selling the first 10-cent higher move. Probably very little appeal in the next 20 cents higher. But we hear from some of our people in the industry, and I don't think it's a well-kept secret that grower doesn't have a lot marketed. So where is it where that exits at if things get really dicey? And I think it's going to take a little bit of space should we get some encouragement to exit shorts and maybe scare some end users into buying some new crop. So,
yeah, very good. I was reading a story this morning, Justin. Some of the larger banks are starting to come out and give some forward guidance and things of that nature. And it was interesting to see that their opinion of the dollar by next year, calling for a between a 12 to 9 to 12% kind of break in the dollar. And it's interesting to see what that could look like, from a commodity perspective, and balance, put that against our balance sheets and the prospect of, let's say an average crop or what that looks like. I guess interesting to hear your thoughts on that.
Yeah. I mean, obviously if, the debt continues to go up, some of these things happen. We're kind of stuck with interest rates that are being stubborn on going down. If it ends up that we, basically weaken the dollar by, some of these policies that we have to do. Yeah, I think all commodities should have a bid to them. I do think corn, soybeans, even wheat really are probably getting pushed under levels that are kind of generally supportive with kind of the macro situation that we have. I think feels like to me like we're already trading like we have this record crop, and you have to prove that prove the market wrong that it's not a record crop, and we don't have burdensome supplies. I feel like Dustin said, we've been a broken record. Every time you get below call it 440 D's corn, I just don't see I don't see the need to sell it here. I think there's too much support. We got good demand down at these levels. Now you could go have a 185 yield and all those things, but that's after pollination. That's after you've, proven grain fill. We've had a really hard time in this country finishing off a crop anywhere over 180. And I thought last couple of years for sure we would have had it, but you end up taking 20, 30 bushels off some of these crops, like Illinois, for example, last couple of years. You don't finish off August very good. I mean, you've got to go to get the kind of numbers that we've got written down or higher. You've got to finish off, all the way through September with good weather. And now we've had a good start. I think we've probably traded that we have the best start ever, which I think we're just kind of average, but I think just the market action is kind of dictating people's opinions on how good the weather is. I think it's an average start personally. And I think the funds, they're going to try to be short until it doesn't work, to Ben's point. And if it doesn't work, then, I think your imagination, I think we're just so used to 430 or, whatever price that if something did turn bad, I think you'll all of a sudden look at, wow, the world's, on, a decade low stocks to use for corn and all these things that we've kind of put on the back burner because it's not working. I think we're going to see that we're really not burdensome at all. We're actually pretty firm. So the weather's too good right now to trade any of that, but I do think we're pushing down to levels that are pretty cheap.
It's kind of bizarre because generally, our focus is on risk management and, farm profitability and things of that nature. And it's interesting for us at this stage. You got by most accounts, the crop planted, it's coming up, starting to look good. And we're preaching patience because of the way that, it's really hard at this point.
We're talking to ourselves half the time, but you think about take ECO, for example, we talked about a lot on the show, but like these 95% policies, whether it's ECO or some private products, and you start fine tuning your own yield, for example, if the weather were to turn bad, all of a sudden your effective floor is rising the whole time. Right. So it's even less incentive to sell if there was a negative weather event. Conversely, if it's really good weather and you're looking at, 10% above APH yields, right, your effective floor is dropping the whole time. So it's kind of like a moving put floor with these big crop insurance policies. So it can kind of have like this leverage effect. If the whole, the I states start looking at like record-y type yields, those floors go from, call it 440 down to $4, for example, or, if we get into a drought or a real bad situation, those floors go up the same way. So, I think it can have some really interesting effects this year when we look at marketing, once you get into that pollination window and beyond, when you're really starting to get a better idea of what that crop size is. I think these big policy and these government programs are going to have even a bigger effect on how that market behaves personally.
Sure. Ben, real quick, we got, we've referenced it a number of times, but Elliot brings it up again, this huge short in SRW, HRW, and Matif wheat. Maybe give us a few thoughts on just what your opinions of wheat are here, at this stage.
Well, it's been very encouraging to see hard red wheat business. I think that the big short is here. They're getting their 15% a year to roll it. They don't seem to be really afraid of this market. I think they need harvest to get here and kind of view that as maybe they're out. And I think the period from early July through September, I think wheat gets really wide open for a bigger short covering rally, especially if you see any, um, any deterioration in the corn crop. Um, and they're fighting that right now. They're fighting the short with, probably since the beginning of the war, maybe the biggest escalation that we've seen over in Europe. So, commodity markets have a way of hitting you when you least expect it. I don't know if this is that period now. My guess is that wheat's troublesome into, through harvest. It's going to be tough to really rally it. But I think once you get past that, they cannot cover their short. It's much in soft red particularly. It's much larger than the crop, and I really don't think that a lot of producers are going to cash sell wheat across the scale at sub $5. So I think that if we do break, I think it winds up being a kind of a V-shaped sort of bottom where all of a sudden wheat's right back in the game. So
I was gonna make a comment just on I was out yesterday, but just looking at what like corn spreads did, for example, in one day, really from the July contract all the way through December of 26, kind of an interesting high value move. I thought, you finally got July D's to a carry overnight. You got D's, out to 27 and a quarter. Those are pretty, that's pretty wide for D's this time of year. So I just thought that was interesting looking at it's the highest, I think yesterday was the highest volume in like 2 months for the December 25 versus December 26 spread. I don't know if you guys had any insight into that, like what happened yesterday, but it seemed pretty high volume and kind of a liquidating type feel in corn spreads throughout the entire curve.
Yeah, it feels like it's much wider than it should be at this time of year. That's for sure. And it did feel like it was more of a get me out type of a trade than a get me in.
Yeah.
I've heard it from a couple of commercials that they're saying if we have, we're expecting really, really wide spreads this year because the acres and the setup in the river. And it might end up being the case. But, I think that you still have to go improve a crop. And if you're talking about like the fact that we are competing with Brazil in July, right? Look what's happening to our July contract right now as their safrinha corn prices collapse, their front month contract is becoming new crop, and their values are collapsing. July is going back toward a carry against December, and it was 40 over not too long ago. That's something to be said about the July 26 contract as well. If we're going to continue to incentivize global corn production because of the currency arb between the US dollar and the Brazilian real, we have to assume that we have another crop to compete with in July 2026. And we don't really have a crop grown yet. We have an extremely high fertilizer cost right now. We don't know what this year is going to be like. To start pushing Deesh July below 30 under, I mean, I'm all for 60% of full carry if we have 95 million acres and we have trendline yield. I think 50 under is very possible in that spread. But, it's the same thing as any seasonal. We make seasonal highs in June typically for a reason, is we just still don't know what pollination weather is going to be like. We're not making the crop in May, and we're just starting, to Ben's point earlier, just starting to get a dry extended forecast again. Doesn't mean that there's any sort of confidence in that forecast, but you imagine what some sort of a 177 or 176, outcome would be for that spread from 30 under in this environment. It's just, I think it's way too early for me to feel confident just like selling that spread, knowing it's going to keep going lower. There's minimum return for the risk, in my opinion.
Yeah, and I just think that's very telling of what the market's trading right now. It's trading big carryouts, big yields. So I think we've factored a lot of that into this market. Not that we can't obviously go lower. I think if we, to your point, if we end up, north of a 180 yield, we'll probably be cheaper than today's prices. But I think that's what we're factoring in here. You know, that's kind of my point about, you know, because we got it planted, now we want to trade that we've already made the crop. So
I would like to say too is like I still think the verdict's out because you mentioned all these products, right? In a sense, a $3.50 corn price is better than a $4 corn price for many growers, right? Because of all the things that double pay, the farm bill, the crop insurance, any hedges they might have in place. You know, if you look back to the end of 2023 when we had a bear market, we finished that year with really wide spreads. We had Dees July at like, you know, well, close to the 60% carry mark. We had Dees at a 58-cent carry. That's Dees 23 to Dees 24. And that happened when we were at 450 Dees 23 and 508 Dees 24. Right? So spreads may end up doing a lot of the work. In fact, I would actually worry that might be one of the worst case outcomes is that we finished this year at like a 430 Dees 25 price and a $5 Dees 26 price, right? Because the market needs to incentivize global producers to actually make money. And that would easily be the case if the dollar index is down in the low 90s again, like Dan was talking about earlier on the show, and the real is up in, you know, 19, 20 again. Kind of rebounding after last year's big sell-off. You know, everything is still dollar denominated. Wide spreads could end up being the outcome, and it's not really even a flat price drop. So we have to be kind of, you know, open-minded about what the possibilities are.
Very good. Real quick here. Good morning, Rye. Tough packer margin, slow kill, kind of taking the forefront on the livestock, and then back end of hogs seems to start to be the story shaping up here. So I guess give us a few thoughts here this morning.
Yeah, it just kind of seemed like we were seeing some of the longs start to roll further out yesterday. You know, cattle just kind of an inside trade, but still pretty good gains. I think everybody's still, you know, relatively optimistic, but there's going to be a lot of eyes on beef prices, especially with these tighter slaughters. If slaughters start to pick up, question is, you know, what happens then? We just load the pipeline, beef prices collapse. How are packers going to bid going forward? So I think there's just a little bit of caution going on right now, just because seasonally we kind of are in that time frame. So it still feels like we are trading some of the day to day. We got option expiration on Friday, and then we got first notice day. So coming into delivery, it feels like that basis could tighten up. The question is, what's right now? Are the futures have it right, or do they need to come up to me cash, or are packers just going to back off and keep the kill, you know, keep the kill just kind of moving around in these tighter fashions? So a lot of questions here, no cash yet. Just kind of watching the price performance in the beef pretty much for the week. And on the hog side of things, it really does kind of seem like we're seeing that interest in the back end of the market. Seems like once again, longs are kind of moving forward here. We got new highs for the move here. We're knocking on the door of contract highs again here. So, you know, forward margins are good. I think just in general, it seems like it's kind of an easy trade from a producer standpoint, just because you got these big premiums in the market. You've got a little bit of a shaky cash market right now. You've got a discount on the index relative to the board. So I think there's a lot to keep the focus on right now. And which is right, we don't quite know yet, but it just seems like there's some good opportunities in the future that producers may want to jump on.
Very good. Appreciate the update there. Just came into the open. We got July corn now up penny and 3/4 at 440 is the last. July soybeans up 7.5 at 1041. And July Chicago wheat's up 2 3/4 at 541 3/4. We appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like and certainly subscribe. It doesn't cost you anything to do so, and it'll keep you up to speed on everything that's going on with the AgYield. So again, thanks to everybody that supports the show. We're doing this live every day that the markets are open on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good show. Hope everybody has a great day, and we look forward to talking to you again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.